For anyone that is following the luxury sector from an industry perspective, rather than purely as an equity trade perspective, the implications of this structural shift are significant. First and foremost, the share price moves are becoming less reliable signal of fundamental health. A 14% rally does not mean carrying is recovering, and an 8% decline does not mean LVMH is deteriorating. The signal to noise ratio has collapsed, and reading too much into any single day's price action is increasingly misleading. Secondly, the management teams are now operating in an environment wherein their words matter as much as their numbers. The difference between Arnault's cautious tone and Temayo's more optimistic framing may have moved more equity value than the actual revenue or the margin figures that they were discussing. And this creates a perverse incentive structure wherein executives are rewarded for managing market expectations as aggressively as they manage their businesses. And thirdly, the long term investors, that is, the pension funds, the family offices, and the sovereign wealth funds, are being forced to tolerate volatility levels that were historically associated with much riskier asset classes. The question that whether the luxury stocks deserve their premium valuations becomes harder to answer when the holding experience involves regular 10% swings driven by hedge fund positioning rather than changes in consumer demand. And lastly, and perhaps most importantly for understanding where the sector goes from here, the presence of large short position creates a coiled spring effect. If the luxury recovery gains genuine traction, that is, if Chinese demand returns more convincingly, if Gucci's creative relaunch under Demna resonates, if US wealth effect holds, the covering of short positions could generate a rally that far exceeds the fundamentals alone could justify. Conversely, any genuine deterioration in the recovery narrative could see shorts pile on further, creating a downward spiral that overshoots on a way down. In wrap up, we can say that the luxury sector has always been cyclical. What is new is the degree to which this cyclicality is being amplified, distorted, and sometimes manufactured by the structure of the market itself. For the investors and for the industry observers alike, understanding the trade is now as essential as understanding the product. Now, that's what we wanted to share with you with respect to the luxury sector and the hidden trades behind the luxury sector's wild swings. Hope you've enjoyed the video. Stay tuned in for our next one.